Beautiful. Welcome to the third week of September. It's wild, eh? Like, I don't know about you, but we have been hit with, almost fall weather immediately.
Fall came full force today. Was the first day of fall, and it's like, but you know what feels good is you put on the nice pea coat or whatever. I'm like, I like this sort of. You're looking good. You layer up when you go
Yeah.
out. So
Yeah.
you gotta always look at the positives, man. You gotta take some positives.
Everything to hide the winter body that's coming on.
Exactly,
That's
exactly.
awesome, man. And like, temperatures dropping, the interest rates are doing the opposite, right? We just had the Feds
Yeah.
down in the States raise another 75 basis points. I think two more meetings for Canada, one in
Two more
October,
meetings
one.
this year, October and then December.
Yeah, so
So
pretty
one
pretty
later in
important dates to
October.
watch out for.
Yeah, so later in October and earlier in December, we get a little break in November from there. Kind of not inevitable, but probably likely some more increases coming, right?
For sure. And reason I wanted to bring you on, you're on the mortgage side of things. You're seeing a lot of apps coming in. What are you seeing in the current market? What do you see kind of happening in the next 3 months?
So we're at this point right now where we're seeing a lot of with this last rate increase that just happened, the variable and adjustable rates kind of coming at par with the fixed rates, right? We're seeing them almost level right now in most cases. So now it's really about having those conversations with clients that yes, interest rates are not going to stay this high forever. They are going to come down eventually, depending on what happens with the economy. So it's a budgeting scenario where, more so than anything, I've always been a big perpetuator of the budget over the interest rate, right? Let's figure out what your actual monthly spend and carrying costs are going to be. But now, so especially because if we're still, and I am still saying the adjustable or variable rate is better to go with right now, even if we see it go higher than where the fixed rates are at in the short term. You got to think about taking a 5-year fixed right now. Well, you're locked in at this, potential peak of interest rates for the next 5 years. So let's look at adjustable variable or a 1 to 3 year fixed rate, maybe at most, so that we can kind of better predict what's going to happen, or wait till we see what actually happens, and then we can make an adjustment there with your mortgage.
For sure. And I think going along with that mortgage, like for the people watching, the higher that mortgage rates go, it does have a compression on property values, right? And we're
Exactly.
seeing, yeah, we're seeing on our side, like the recession is definitely slowing things down. I'm sure you're seeing the same thing in the number of apps coming in, right?
Yeah, definitely. But what I have noticed too, which is interesting, is maybe like a more informed consumer coming through with the applications that I am getting. So there might have been, when interest rates were super low, and the prices were kind of going crazy. Yeah, we saw an influx of pre-approvals and applications that I was getting in, but then maybe 50% or less, maybe even 30% were actually either getting into a property because of the bidding wars, or they were actually serious about moving forward, not just saying like, oh, let's just see what, oh, the monthly payment's low, but it wasn't actually feasible for them to carry it, especially when you have those conversations with interest rates aren't going to stay this low forever, right? If we're taking a variable rate at 1%, it's only going to be X amount of time before it goes up. Where now I'm seeing with the applications coming in, they either have, spoken with the right people, understand that the interest rates are cyclical, and that you're essentially getting a deal on those properties out there. So I know you had mentioned about maybe not buying the most expensive home when we were talking last, but buying something else that's more reasonable or a stepping stone right now is a great idea.
Yeah, and I think there's some pretty great opportunities, when you partner with the right people and you really get a firm understanding of what's out there. And I guess before, I'd love to bring in the idea of that, going for something that's more of a fixer upper and a long-term and better investment. People can lock their rates in for 120 days, but what are you seeing right now, given that there's two more increases? Like, just before we jump into the product, I'm curious, what advice would you have to give someone who's coming, looking at houses in the market and then talking to you for pre-approval, pre-qualification?
Yeah. So there's a couple of things that people need to kind of to realize that they don't know. That's not intuitive anyway. People wouldn't think like this. When you go in to lock in a rate, a couple of things, I always have these conversations. A lender, generally, most lenders, there's some that'll put less of a premium on them, but some that'll put a lot. They're tacking on a premium to that rate hold. So yes, maybe their rate's 4.5% right now, but they're actually going to hold that rate for you at 5.25 or 5%. Right. So people don't really understand that. And I definitely have to explain that to people with, yes, if the rates go above that, then we're protected with that 5% rate. But right now, you actually get a better rate if you actively kind of jump on a deal right now. As soon as that deal turns live, we're going to get the lowest rate that's available at your either the rate you're locked in or less than that if it's still available. So that's on the fixed rate side of things. So generally, most lenders are going to put that premium on. The second thing to note would be, because a lot of people didn't maybe get this fully explained either by their bank or their broker or whoever they're dealing with for their mortgage advisor, was locking in like a variable or an adjustable rate, right? You're actually locking in the discount off of prime. So just because you're locked in at prime minus 1%, when the prime rate was at 4.7, well, now it's jumped up to 5.45. Your rate has actually still gone up that 75 basis points, but you're still locked in at prime minus 1% or whatever it was. We don't have that large of a discount. I'm using generalizations, but
nice if it was.
yes, exactly. Now it's more like 0.5%, whatever. Like insured deals, you can still get close to that, but it's important to note that one, on the variable and adjustable side, you're locking in that discount off of prime, not the interest rate at the time, or else that would be obviously fantastic during these rate increases so quickly. We could have still been giving people 2-3% when it shot up to 4%, right? So that's important to note, and that most banks and lenders will actually put that premium on the fixed rates. So that's important to note that yes, you will always get the lowest interest rate that's available, but at the time your deal actually goes live, even if you're locking it.
Right. And it's so funny because you have the conversation at, 1.95 even. It got pretty low for a while there, and people at that rate can really stomach, even $1 million buy. Right. And there's some people who are looking at that threshold. So now we're kind of in a situation where interest rates are a little higher. It does affect affordability, and one of the conversations that I'm having with a lot of my clients is like, rather than step for the dream home on your first or your second or third purchase, there's a lot of really good value properties out there that might need, hardwood instead of carpets, or an immediate painting, or maybe there's, a bathroom that needs to be fixed, right? And I know we've talked about it, but I want to hear it from the horse's mouth, purchase plus improvements. How does that work into a deal where someone could actually buy a property that does need a bit of work and actually wrap that into their mortgage?
Exactly. So it is a fantastic product that's underutilized. And I think the reason that this is by a lot of people is that, one, maybe they don't understand it, or it's just not as widely out there or published or advertised, right, to clients. And two, you have to have a very good team behind you, because the way that this works is not just a bunch of money up front for you to be able to go do whatever you want, right, to the house. Like it's a more strict rules behind it. And oftentimes the lenders that have the best purchase plus improvement products, like I have a lender that I work with frequently that goes up to $100,000 that they'll loan you above in different installments to do pretty like extensive renovations. You can do a lot with $100,000. However, they're going to release it when the work is actually completed to essentially pay off that debt that you have. So you either have to have, in addition, savings or some sort of line of credit or something you can tap into after closing on the property for what you actually paid for it at, or you have to have a great team, like a contractor that understands this, that's going to take a small deposit in order to do the work, and then understand once his work is completed and it's up to standard and up to code and everything, an inspector comes in, checks that off. Now those additional funds are going to be released from the lender, right? And then that it's generally done if you're doing, say, a bathroom and a kitchen and then paint and then whatever, like you have a multi-step process. They're not going to just say, okay, yeah, get it all done, or here's all the money to do it. You're going to have to complete something. Inspector comes in, just like how you'd initially get an appraisal done on a property and say, yeah, this is done. It's increased value by XYZ, or they've agreed upon it. Here's the funds to then pay the contractor out or pay yourself back the money, whatever it is, right? So that's important to note. And the way that it actually works, you buy a $500,000 property. And after all you'd get an appraisal done at its as is value and what its as completed value would essentially be. So you'll say, yes, it's worth 500,000 right now, but with this new, paint, finishes, kitchen, whatever it is you decide to do, flooring, whatever it is, then they'll have an as completed value. And that's the amount of funds that essentially you would have to work with. But you can't also change your plans. That's a big thing where people maybe fall sorry, I'm mumbling over my words there, fumbling, that they don't understand that they can't just decide, okay, we put in this new kitchen plans and everything, but now actually we're going to add in a pool and do something else and say, well, we've increased the value, haven't we? And go back to lender and they say, no, you didn't follow all these rules. Now we can't release any funds at all to you. Right. So that's where a good explanation, having a good team behind you, mortgage broker, realtor, contractor, relations, lawyer, appraiser, and having a good lender and understanding the lender guidelines are important to really utilizing that product.
Yeah. And I guess for someone, so, they get a great buy, we go through this property, they put in a new kitchen, bathroom, the value adding type stuff. And let's say they wrap it up and then, they go to negotiate in, 3 or 5 years for their next mortgage. They can always refinance at that point for the pool or the
yes,
entertaining
exactly.
stuff,
Yeah.
Awesome.
So it's always good to note that one, you have to follow those plans to a T, because obviously lenders are basing their evaluations or their as completed evaluations to those plans being fully executed and completed. So anything off kilter that's not from your original planned renovations will cause issues. And sometimes it can still get done depending on what you do, but that's a very exception based. If you're adding extras, it's best to talk to your broker or lender and make sure that everything's okay if you are varying from the path.
And for the people who are kind of listening and, thinking about varying from the path, we're not talking like a slight change in fixture. We're talking an overhaul of, all of a sudden now there's a full extension that was never planned for.
100%. And then it's important to note that as well, that they're not ever really going to approve giant structural. You can't bring it down to the studs and then kind of rebuild on this. You probably wouldn't have money based on a lot of these projects programs. But it also is important to note, that you say, kind of making a joke, changing fixtures and things like that. But they also don't want non-marketable things in your property as well. So if you're switching to all gold faucets and black toilets, that actually might be, you need to be aware of that, because when the appraiser comes in and goes, they did something really weird and niche in here, the lender's always got to look at marketability and selling of that property, worst case scenario that you don't pay your mortgage, right? So those things, as much as it is a joke, just changing from one to the other is fine, but doing something crazy that's very unique to yourself or going outside of the realm of boundaries, regular sort of boundaries, it could cause problems as well.
Absolutely. Yeah. And it's funny because we were talking about the recession a little bit, and I think that's kind of the big topic, right? There's a lot of people right now that, spending is slowing down, right? The market's absolutely cooling down. In Ottawa, we're down, I think 179,000 for our average price. I still think we're kind of entering a market where it's more fair than anything else. It was overheated, it's cooled down a bit, but it's not crashing yet, at least. And the interesting part is buyer demand also shrinks a little bit, which means the people who are kind of watching these kind of videos and learning about different ways to structure a deal are kind of getting further ahead because they're seizing up the opportunities of the cool market. Right. And it almost seems like the real thing that's gone down is the seller's ability to just continually ask for more and get it.
Yeah, for sure. And the realtor's end to just put a listed or a for sale sign in the yard and say,
and it's gone.
buyers come aplenty. Right. So it's definitely seeing that cooling. But I'm working with a fair amount of still first-time home buyers. Actually, I had a fair amount closed this month on first-time home buyers. So they are, like you said, people that are understanding the market and taking advantage of that. And also being able to, my last 4 deals have all had financing conditions, inspection conditions, everything regular offers in there. So
real due diligence,
Yeah, exactly. Right. Which makes my life easier too, in terms of the mortgage side of things and getting that approved and not being an issue. But I've also seen a fair amount of investor clients that I work with that are loving this market as well, because they can they can forecast or stomach, the ones that investors that can stomach a little less cash flow, right? That are saying, okay, yeah, my interest rates are very high, but my mortgage amount that I'm getting is 100,000 less than it was, 6-7 months ago. So that's a discount to me, right? So I can stomach even being cash flow negative for the next 12 months as the interest rates are high. But as soon as they drop, I'm going to refinance, I'm going to pull it back, and I'm going to drop those rates. And all of a sudden, now my cash flow is positive, or at least neutral. And I'm going to hold this property for 3, 5, 10 years, right?
Which everyone should be doing anyway.
Yeah.
It's continuing to be just, a good long-term investment. And I know, for the investors watching this video, this is probably going to be a situation where they know about the deal. They know what they need to do, but you bring up an interesting point, and that's first-time home buyers, right? So, we work with them to go find a deal, get the listing agreement, all that kind of fun stuff. What can a home buyer, a first-time home buyer specifically, kind of have ready so that it makes the lending and the financing process just that much more smooth?
One, it's obviously, documentation on everything is going to make it easier for a pre-approval process to go very quickly, move quickly. And really for me, and this is why I focus so much in the pre-approval process with my first-time home buyers on budgeting and realizing the actual carrying cost of the property, right? Because a lot of people will say, yeah, or a bank or another lender, whatever it is, say, sure, you're pre-approved up to 650, go find a property. Okay, they get an accepted offer. They come back and they go, okay, well, your mortgage payments are $2,400 a month, and that property has a $600 condo fees, and your property taxes are break down to $140 a month, and then utilities and everything else. Like, well, I can't afford this. And it's like, because you didn't do sort of the due diligence in the start to actually realizing the carrying cost of owning property. And a lot of first-time home buyers may be financially ready on paper, but then you have to break down that mental shift of going from renting or living with family or whatever you're doing before to property ownership and all the other associated costs. And if it's not a condo and it's a semi-detached or detached home, realizing all the maintenance and everything with a full home as well. That's why sometimes the condo fees, people are a little bit cheesed with the condo fees, but at the end of the day, you break down how much it costs to maintain a property and all those expenses. It's very very similar depending on what your condo fees are, or more favorable, right? To
For sure. And you're not having to buy like the lawnmower, the shovels, or paying a service, right? Like there's definitely some benefits there. And I guess that's always kind of a consideration as on the home search. Now, I know that we've taken up enough of your time, Zac. I want to make sure that, we respect your time. So what we'll do is we'll end it. But if people have questions, Zac, thanks so much for joining us. If you do have questions, drop them in the comments below. We're happy to address them, and it may even be featured in one of our upcoming videos. It's important that buyers now more than ever, especially because they have that negotiating power, is to do a little more due diligence, make sure their research is done, and partner with all the right people. So what I'll do, Zac, is I'm going to include your contact below. So if people have mortgage questions, they can actually reach out to you directly. Even if they're not working with me, which they probably should, they should reach out to you and do the financial due diligence side and learn a little bit more about the mortgage. And we'll include your social handles, because I know you got a ton of fun stuff going on your social. So it's a nice educating and entertaining experience. You've really mastered it well there.
Well, thank you very much. Thanks for having me. I know, like you said, leave some comments down below, and I'm sure we'll do many more future videos like this and hopefully help some more homeowners soon.
Awesome. Thanks so much. We'll catch up later, Zac.